Welcome, everyone, to the Expansive CEO podcast. I'm your host, Hannah Chapman, and today is Thursday, December 18th. It is currently 2:18 p.m. Mountain Time. So, this is, I think, the last one for the year, our last investment Friday for 2025. And I'm here with my good friend, Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. Brad, here we are. We made it.
We did make it. Thank heavens. We are here and it's been a great year. I mean, we had
Honestly, yeah.
some bumps along the way, but nothing too dramatic. And, for people who are trying to save for retirement or investing, this was a pretty decent year. And your portfolios probably reflect that
Yeah. Yeah.
to
I
a certain
mean,
extent.
yeah, there have been a lot of happy clients this year
Yeah,
at least.
I mean, for sure. This is the U.S. stock market was up 15% essentially through yesterday or today. Global stocks were up 30% almost. Um, you had the bond market return 7-8% depending on what part of the market you're in. So all told, given the amount of uncertainty that was introduced this year with um, President Trump's new initiatives, from tariffs to the one big beautiful bill and everything in between, um, and the kind of chaotic implementation. I mean, the markets have done really well and been really resilient when it comes to dealing with that kind of uncertainty.
Yeah, absolutely. And just to um well, we're going to talk about that right now actually. So we're one of the big bright spots in returns this year, a big driver of returns are the stocks that are part of the AI trend, right? And so we've talked about this a couple of different times, and we've gotten lots of questions from clients too around is this a bubble? Is AI a bubble? And we've kind of talked about that before, but we have a little bit more nuance to add to that this week. So let's talk about that. You know, the driver of so much of this return this year and where we are with uh, the AI trend and the companies in particular that are really driving most of it.
Yeah. So what I'm going to take are my comments is from an economist who wrote this decades ago. But what he did is he analyzed a lot of the boom, the bubbles, and the crashes over the past couple of hundred years. And what he did is he distilled them down into three different events have to happen to make a bubble occur. The first one is there has to be some kind of pervasive change, a major displacement, whether that is technology, which in the last couple of times has been ours, but it could be, for heaven's sakes, the invention of the wheel. That was a major innovation, right? All the way to the steam engine, the locomotive, cars, the industrial revolution, computers, internet, and now here we are at artificial intelligence. All of those changes have created an excitement within the economy, within the investing community, and that is one of the critical factors to create that opportunity. The second thing that has to occur is there has to be a way for the average investor to invest in them. Okay. So whether it's publicly traded stock or exchange traded funds, there has to be a way for the average investor to get involved with this displacement. In our case, artificial intelligence. We clearly can do that today, as the average investor for very little cost can get involved and uninvolved as often as they want. It's very cheap, very quick, to gain access to these securities. The third requirement is uh, we have to have cheap money, inexpensive financing, and that's what spurs on this aggressive risk taking on the investor's part, and that is what we don't have today.
Okay.
Um, we're coming from expensive financing down to right now we're about neutral with the Fed just lowering interest rates again um, by a quarter of a point or 25 basis points. But it remains to be seen in 2026. We're going to have in May of 2026, we're going to have a new head of the Federal Open Market Committee. The current chairman, Jerome Powell, his term is up, and President Trump has notified everybody that he will not renew that nomination and that he is going to replace him. And he has been very publicly looking for someone who is going to be, he's going to err or she is going to err on the side of cheaper financing costs, lower interest rates, in other words. And so that, depending on how easy or aggressive, however you want to term it, the Federal Reserve gets with lowering interest rates, that could potentially set the stage for the artificial intelligence boom to convert into a bubble.
Mm.
We're not there yet. We boomed. And the reason why I'm saying it's boomed and not a bubble is because one of the biggest things that happens in a boom and not a bubble is revenues and earnings kind of lead that way. And you can see that with the massive amount of growth in earnings from Microsoft, Google, all the hyperscalers, NVIDIA, all across the infrastructure application and power generation, sectors of the economy due to the artificial intelligence build out. Um, that is, again, that's earnings have come with it, not necessarily. I mean, not for every company, but most companies have been financing these capital expenditures out of free cash flow. There's a few that have been hitting the debt markets pretty hard, which we've discussed in the past couple of episodes. But again, for the most part, it's a pretty solid boom.
So, what we are looking for, and we've talked about this for, gosh, probably the whole year at this point, as well, is that the AI trend is in still in its early stages as a cycle, as a full cycle, a technological cycle. And so we're still at the very front end of the application of said AI. And what it will actually look like in 5 years or 10 years or 15 years or 20 years is yet to be seen, but there's so many other applications than just what we're seeing right now, which has been we've seen quite a bit of layoff. A lot of companies have done a lot of layoffs that they are, citing AI as a reason for. But I don't know if that's really gonna like stick.
Yeah, I think that's more public relations at this standpoint. I mean, artificial intelligence is helping larger companies with some very mundane tasks, very administrative in nature, um, but it's not developed enough to lay off 10,000 people. What's
Right.
more likely with a lot of these announcements is corporate managements have held on to workers for the last 4 years since the end of the pandemic because it was so difficult to hire people then. They didn't necessarily want to kind of let them go until they were confident they didn't need them.
Mm,
Well, now you're looking ahead and saying, well, if you're an admin worker and I can see in the next 12 to 18 to 24 months that I can replace most of your duties with a computer system, I'm probably going to let you go a little early, particularly if I can't keep you busy enough.
mm,
And that's where a lot of these employees that are getting laid off were underutilized in their corporate structures, and so it wasn't as efficient as possible. And that's where I think a lot of these corporations are going. Okay, it's 4 years, 5 years almost past the pandemic. It's now time to start kind of right sizing our labor force and start utilizing some technology, more technology to fill those gaps. Um, in every technology revolution or innovation, there's always this creative destruction where the new technology destroys old jobs but creates new ones. Um, we don't know if that's quite the case yet with artificial intelligence. A few technology people that I have read, their reports have discussed how artificial intelligence, the combination of artificial intelligence, drone technology, and robotics, the fusion of those three will enable companies to not necessarily enhance their productivity, but to replace some employees. Now, that means there's other jobs being created in other parts of the economy. And we can see that with the build out in utility space from just from power generation, the data center spaces. Now, they're not going to employ everybody being laid off, but again, that's part of that creative destruction attribute of a new technology being introduced.
So I just had a thought that I hadn't had before, literally until just now. It like occurred to me. So this is a I haven't given you time to think about a response to this, but I'm just going to throw it
Okay.
out there that I wonder if part of um, the wave that we've seen in layoffs, if that's also due to the employee retention credits that, I mean, we're going that businesses were still finalizing and getting through over, last year, the year before. That was a big deal. Businesses were getting a lot of money back in taxes from those employee retention credits. Um, and I'm just wondering if that ended officially this year, and now they're able to start letting go of those employees that they retained. Like you said, like it's still from the pandemic, but those tax credits that they were receiving for retaining those employees are now gone.
Yeah, and I mean, that certainly raises the marginal cost of that employee, right? If they're receiving credits that lowered their cost, maybe it made it tenable for them to hold on to those people until those credits expired, and now they're bearing the full cost of that employee. So if they're underutilized, they're like, well, we probably shouldn't be paying them any longer, and we just need to reduce the number of positions we have. Um, in the last part of 2025 here, we've come into an economy where there's no hire, no fire, right? Um, in general, in the tech market, that's been different, but in general, it's been, hey, we're not going to hire a bunch of people, but we're also not going to let a bunch of people go across the board. And so it'll be interesting to see. We did go through a soft patch here in a little bit. Not it actually was much stronger than most people anticipated going into this year. Much stronger than I thought going into this year. Uh, the economy has performed quite well. It's that K-shaped economy where we're bifurcating into the people that are enjoying a lot of the prosperity right now, and there's the other part that are being kind of left out, and
Mhm.
that's a problem socially, but economically, if enough people are in the top part of that K, then overall we're fine. And that's just unfortunately, it's a matter of fact with economics. But um, yeah, I mean, the economy has done quite well. I think it could continue to strengthen as the recent interest rate cuts are going to be taking, are going to be rolling through the economy now. Um, let's see if the Fed desires to continue to keep cutting. My guess is if if the economy weakens, if the labor economy continues to weaken, and which I expect inflation to decline.
Mhm.
Uh, we have disinflation, right? The rate of inflation coming down, then we could see some more room for the Fed to move and lower interest rates, which should, again, add further strength to the US economy, which should be okay. Um, Earnings have been really, really good on US stocks. I think that's probably going to continue, although I think we're, the emerging markets are some places that people should start to look as well for some values and some bargains.
And I'm going to plug again, we talked about this last week, but I'm going to plug it again that you'll have your 2026 look ahead ready soon. So if anyone
A
who's
couple of weeks.
a couple weeks, anyone who is not, if you're already a client of X Squared or of Juncture, you will receive that. You'll get that in your email. If you are not and you would like to receive that, just send us an email and we'll send that to you so you can see what Brad's thoughts are for 2026. And then when we get to December of 2026, we can look back and see how you did.
Yeah, I
Fair
mean
enough.
that's effectively that's what I'm doing right now is reviewing 2025. And I did get a few things right, but I did get a few things wrong. So, I go through and I list those and why and whether I was just early or wrong. So we'll see. We'll see how that all rolls out. But
We
yeah,
love we
I'm
love
excited for.
we love a humble CIO.
Yeah, well, if you're not a humble CIO, then you haven't been in markets long enough to know that they'll humble you very quickly.
Yes.
So, um, yeah, I mean, I'm 2026 is probably going to turn out to be a pretty decent year, particularly with, and people keep forgetting this, but the one big beautiful bill, what it did do is it is a fiscally stimulative bill.
Hmm.
Okay. And right with refunds coming up and lower taxes here for corporations and households, that will be stimulative to a certain extent, particularly with the freedom checks, which President Trump just announced he's going to send to, I think it's 1767,
1776.
1770, Jesus, 1767, 1776 to every service member. And that's a lot of people. So just
Mhm.
to be aware, it's the largest organization in the world.
Wow. The US
Okay.
military as a whole.
Yes, as the
Wow.
number of people, personnel. So again, it's enormous, and 1776 per person. That's gonna have a stimulative effect. Also, um, there's another thing that called the Trump accounts. Now, I know you've done a little reading on these Trump accounts. Why don't you fill me in on what it is, how
Yeah.
we could benefit from it?
So the Trump account is interesting. There's what tends to happen when any new account like this is it's a hybrid type of account. It's not a 529 plan, it's not an IRA. It's kind of somewhere in the middle. So anytime Congress creates a new account, the IRS then has to digest that and figure out how they are going to implement it. Right. So we have some information, but we don't have all of it yet. So I just want to be super clear about that we will get more information as we go. But I wanted to talk about it a little bit today just because there is some stuff that's happening and rolling through starting in 2026 really soon here. So first things first, the Trump accounts were like one of the things that was said early on was that there was going to be seed money for the Trump accounts. And then the Dells of like the
Dell
couple, right,
computer.
of Dell Computers um, pledged, I think, $6.5 billion to fund these accounts. And so the funding is $1,000 for U.S. citizen children born on or after January 1st, 2025 through December 31st, 2028. So that's a 4-year time span. So if you had a baby in 2025, starting, January 21st, 2025, and you have a baby before December 31st of 2028, you should be eligible for this, seed deposit of $1,000 into the Trump account. The other aspect of this that's interesting again is that it's not a 529 and it's not an IRA, but you can put in up to $5,000 per year after tax. So that is more like a Roth IRA or a 529, right? You've already paid taxes on these dollars. You can put $5,000 in. That account then grows tax deferred. So it's got the tax, you've already paid taxes on the first contribution, and then the growth is tax deferred. That's really important. We're going to come back to that. The other thing, so you can do that all the way up until they turn 18. So from age 0 through 17, you can put $5,000 per year into this account.
And who
When they,
can put it in there?
uh, it says anyone. So a parent, a grandparent, the child themselves, if they have money for some reason. Um, Also a business or a charity. So the business is interesting. It says an employer may contribute to a Trump account of the employee or the employee's dependent up to $2,500 per year, which counts against the $5,000 limit. So it's not on top of, it's within that $5,000 limit, under an employer's Trump account contribution program, which implies that there has to be a Trump account contribution program for that employer, and the contribution will not count toward the employee's taxable income. So an employer can contribute, parents can contribute, grandparents, aunts, uncles, anyone, and also charities can contribute. And from that perspective, so for 18 years, you can contribute to this account. Once the child turns 18, it turns into a traditional IRA. So this is the piece that's like super interesting and that we're going to have to see like what that's actually going to look like, because after that point, when they turn 18, it turns into a traditional IRA. What are the rules of a traditional IRA? Rules of a traditional IRA are that you cannot take money out until you're age 59 and a half. Otherwise, if you take money out, it's penalized. You pay a 10% penalty. But I'm just going to go through all the messy right now. But if you've been contributing for 18 years and you've put, let's say you've done 18 years of contributions, $5,000 per year. Hold on. So 5,000 times 18. So you've put in $90,000 into this account. That was already taxed. So you have a $90,000 after tax balance in your now traditional IRA that we have to keep track of, because anything else that goes in is going to be pre-tax dollars and your growth is pre-tax dollars. But when you take money out, now we have to know the balance. How much of
Kind of the
this
cost
account,
basis almost.
the
Your
cost, right, the cost basis, but in planning
contribution basis. Yeah.
your contribution basis, because then say you have $180,000 in there, 90,000 is contributions, 90,000 is growth. That means if you take a distribution, 50% of it is taxable.
Wow.
And so we like have to know all those details, right? It's like it gets super complicated after the child turns 18. So
Yeah.
it's like it's a little messy. Um,
So the details finalized, or are these all draft forms?
from what we can see on the IRS website right now, so this is what I'm reading from is from the IRS, and so they do letters and memos throughout the year, which are official. Those are official communications if they're on irs.gov. But they don't know exactly how they're going to implement this yet. So one thing I wanted to say, like I was looking up this information on a few different websites. On Schwab itself, Schwab posted an article about this the other week, and some of what is on the Schwab article is actually contradictory to what's on the irs.gov website, right? So it's like there's a lot that's unknown so far. What we can say, there's a $5,000 annual limit. Right now, you can put $5,000 in after tax. You might, if you're a small business owner, which a lot of my clients are, right? There might be this little avenue of putting $2,500 in through the business that is then you don't pay tax on that as a business owner. That might be kind of cool. We can look into what that looks like. Um, but when the child turns 18, which granted, we don't have to even think about that for 18 years,
Yeah,
17,
because
18 years.
They have to be born in 26 to 28.
25, 20, January 1, 2025. So this
Oh,
year.
it is. It's retroactive to this year. Okay,
Yeah,
great.
retroactive to January 1st of this year. But that means we have 17 years until that, like the IRS has to figure that out. And that might be part of the thing. They're like, well, we'll just kind of kick the can down the road and figure it out then. Um, so I like as a planner, there are pieces of it that are like intriguing that I want to keep paying attention to that, yeah, maybe that might be a good thing to look at. And then there are a few things also that are a little bit like, that's a little weird. For instance, the IRS memo says the funds in Trump accounts must be invested in certain mutual funds or exchange traded funds that track the S&P 500 or another index of primarily American equities. So, reminder, S&P 500 are the 500 largest companies in the United States. So those are the 500 largest American companies
By market cap.
by market cap. And that's so these Trump accounts must be invested in American companies. So you can say, people will have different opinions about that. I mean, I have clients that will feel like, oh yeah, like all I want to invest in is American companies. And then there are going to be other people that are like, well, why wouldn't we want to be able to invest it however we want? Because in an IRA, a traditional IRA, a Roth IRA, any other IRA, you can choose all of your own investments. There's no one telling
Similar
you.
similar to 529 program.
Even in a 529 plan, you can choose any investment. You can choose an international investment. You can choose whatever. So this one is, it has that stipulation written into the bill as well that it must be either in something that tracks the S&P 500 or another index of primarily equities. So that's interesting to me. It's not, you can't choose individual stocks according to this. You can't choose bonds. You have to choose a mutual fund or an ETF.
Yeah. Well, I mean, interesting. We'll see how that rolls. Now, I heard that Trump there's a one-time $1,000. If I set up a Trump account and I want to fund it for one of my grandchildren, I'm too old to have children of that lower than 18. So, but if I set it up for my grandchild, uh, do they get a bonus for setting it up?
Not
One time.
just the so yeah, let's say you have your first grandbaby is born sometime before 2028. Congratulations, Brad.
Oh,
All around,
thank you.
right? I will not have grandchildren before then.
Yes.
I have kids under 18. So I don't know if they're exactly what that'll look like, but so far what they're saying is that when you open the account and you have a child born in that window, January 1, 2025 to December 31, 2028, they will receive that $1,000 seed grant, basically. So even if it didn't say that in the IRS memo, whether that's a match or just a straight up grant. My understanding is that it's a straight up grant into the account.
That's what I'm reading like on the White House um, on their announcement. It's a one-time government seed contribution.
Yeah. So that tells me that all you have to do is open the account and you'll receive that.
That's my understanding too. But again, I could be. But also, there's also some private donors that have decided to kick in for these accounts as well.
Who's that? Besides the Dells, are there up more that you're
Uh,
seeing?
well, the Dells are one. So Michael and Susan Dell are giving $6.25 billion away to for people with less than $150,000 to fund some of to help out underprivileged kids. But
Oh, hold on. So that was the $1,000 seed money coming from the Dells has that income stipulation?
it says so. No, I think the $1,000 is separate uh,
Okay.
because it says the Dell's unprecedented gift, the first 25 million American children aged 10 and under living in zip codes with median incomes below $150,000 will receive an additional 250 bucks.
Okay. Interesting.
So So in total, if you live in a place in a zip code with median incomes less than $150,000, potentially your grandchild or child could have $1,250 contributed to their Trump accounts.
That's interesting. So that's another nuance. And I didn't do this with 1,250, but I did do it with 1,000. So what I wanted to look at with that was, again, this account so far, when it says it doesn't give any, or rather specifically on the IRS website, it says there's no withdrawals technically permitted before age 18. So it's not like a 529 account, for example, where you can take money out for college expense or excuse me, high school, like private high school, private middle school. Um, you can't take money out of it before age 18. And then again, at age 18, it turns into a traditional IRA, which you also can't take money out without penalty outside of some very specific circumstances. Um, so basically, when you put that money in, or if you open that account, let's say um, you have a you had a child this year, you open the account, it receives the $1,000 seed money, and you don't do anything else with it at all. Um, I'm going to use 8% on this because the long-term average on the S&P 500 is 8%. I'm going to calculate this. So if we assume you get $1,000 in the year 2025 and you don't do anything else with that account and you just let it sit until this, baby in 2025 is now 60 years old and they can take money out of the account. Are you okay? Got it.
I'm good, thank you.
If it's invested in the S&P 500 for 60 years, which has a historical track record around the 8 to 12% range, depending on what 20-year period we're looking at, I put in 8% into this calculator. At 8%, that account after 60 years is going to be worth $115,000. Well, $115,888.74
Wow.
from doing nothing, just opening the account. So, I mean, yeah, I would do that. If it was, let's say we had years that were better and it averaged 10%, that's actually $377,737.96. So almost $375,000. If the account earns an average of 10% per year for 60 years. So regardless, like if you have a child this year through 2028 that you can receive that seed money, like I would not sneeze at that. I would open the account and receive the seed money and then whatever else you want to do with it, at least let it grow.
Yeah.
Because yeah, I mean, I don't know. If someone put $1,000 somewhere for me when I was a baby and it was $375,000 now, I'd take it.
Yeah. You'd be appreciative of the foresight.
Right, exactly. So with that in mind, again, like we don't have all the details yet. We don't know all the different nuances of what it's going to look like, but we we'll keep a track of it with, whatever the IRS comes out with. It's in their hands right now, again, to figure out the tax paths for any of my clients who are business owners or any of our listeners who are business owners. We'll have to see like what does that mean? What kind of under an employer's Trump account contribution program, what is that? Does that mean you have to set something up? Is there paperwork that goes along with that? We don't know yet. Um, but if it's a benefit that's gonna be an easy yes, like yeah, let's get if I have 3 kids that are under age 18. So for me personally, if it was like, oh yeah, I can set this up and get $7,500 out of my taxable income and it goes to them and it can grow, like that might be an easy yes for quite a few people. So we like again, we don't know everything, but what we do know so far, there's some little weird pieces, there's some good pieces, and there's some question marks.
Yeah. I think what you're saying is definitely let's take advantage of it if you can. Um, but know that maybe the details aren't really nailed down for when it comes to 18 years old.
Hmm.
So it's just something that I think the politicians, the IRS, have to work through in setting these up. Now it's in another type of account. I mean, we have IRAs, Roth IRAs, educational savings accounts. We have
529s.
HSAs, FSAs. We have now the Trump accounts. We have a lot of different account types that are able to help us get to our goals.
Yeah, exactly. Exactly. And that's, again, we've talked about this before, but in general, taxes are going to be one of your most expensive line items throughout your entire life. And so if there are ways that we can, mitigate some of those taxes and keep that money in your pocket, and growing for the future, and do that in ways that aren't going to get anyone in trouble, right? Completely all above board, then we want to do that and we want to have that information available. Um, I'll put a little note here just so it's like in our brains, because if I say it again, it'll have a better chance of sticking. And if you're listening and you hear this, know that I'm thinking about it. One thought that I did have, at age 18, is that might be like the right move, quote unquote, right move at that time. Again, we'll see 17 years from now, is to potentially convert that from a traditional IRA to a Roth IRA. And so what that would mean is all the growth that's happened, you're going to pay taxes on the growth, no penalty. You're just going to pay taxes on the growth at the child's tax rate. And then the whole thing is then going to continue to grow tax free and be withdrawn tax free for the rest of their life. So that's kind of where I like, that's the little like bright spot for me, is like that would be interesting if we're able to convert that traditional IRA to a Roth IRA right at age 18. That seems really interesting, um, and like a really good opportunity.
I think that's one of the details that I think will get changed on these accounts is one, it will either make it tax deductible contributions, so then it can remain a traditional IRA, or vice versa. It will remain, the contributions will remain post tax, but then it'll be converted into a Roth. I think that's
That
one of the details they're going to work out, but
is so much more elegant. Like it's because
it's
right
just
now
simpler.
it's real messy.
Yeah, right now it's yeah. To be fair, it's a brand new type of account, and so the policymakers, the administration, and the IRS need to just get on the same page and figure out what detail they want it to be. So, but it looks like a fantastic new way to save for the next couple of generations.
Right. That's what was coming up for me when I was looking at this too, is that it's not necessarily it's not an education savings account. That's not anywhere in the language that it's meant for education, right? So this is very different from a 529, and it's actually a like seeding your child's future financial stability from the time they're born. And we don't really have other accounts that do that with any sort of tax, benefit right now,
Right.
that aren't education specific. So,
Let,
um,
let me ask you this: is there a requirement? Because on Roths and traditional IRAs, I believe there's a requirement where the owner of the account has to have some kind of active income, which then they can contribute up to 100% of that to those accounts. Does this have a requirement that the participant had, or the child needs any active income?
no, and that was actually an interesting piece as well, because from what this is saying, this $5,000 is not in competition with traditional or Roth IRA. So if a child has earned income, let's say they're 16 years old and they have a job, or 17 years old and they have a job, they can max out an IRA, and they can still receive contributions to a Trump account. So they're not mutually exclusive, which is nice.
That's
Um,
excellent.
yeah, and from this is, something that I've talked about a few times, again with my small business clients, especially those in LLC, not S corp or corporation status. If your child works in your business and you pay your child through your business, you can contribute to a Roth IRA for them, right? So they have earned income. You can contribute that to a Roth IRA. The Trump account is also in addition to that. It's so you could still pay your child through your business, contribute to a Roth IRA from their income, and contribute to a Trump account up to 2,500 from the business is what it's saying. So I mean, like
That's quite a bit.
there's a couple of cool levers that if you have the additional income, if you have abundant income to be able to put, extra stuff in different places, it's like another little sometimes I call it squirreling, like putting your acorns, right? You have more little pockets to put your acorns in.
That's perfect because, as we know, and all of the viewers and listeners know, uh, life doesn't get cheaper; it
Right.
gets more expensive. And so, if we can give our children and our grandchildren, or friends' children's, kind of a step up, a leg up, that becomes immensely helpful, particularly because they have such a long time horizon to benefit from.
Yeah, that the time horizon in planning, that is the key. That is always the key. The longer you have, it's not about timing the market, it's about time in the market. The longer you have, the more compounding, the more say like just the more stable your situation is, right? Like it's just that's such an important aspect. And if kids I can even imagine a world where it's like, okay, we're going to teach our children, like, here's your allowance. We're going to put some of it into this account every month or every year, right? We're going to save part of your allowance here, and it's going to get invested, and they're going to start to understand the value of that compounding in a new way, and that's pretty cool.
Yeah, great way to train them. Great way.
Well, Brad, again, we'll leave it there for now. If anyone has questions or if you find out something else and you want to share it, or, again, we'll be paying attention to this. And so as more news comes out, we'll let you know what that is too. But, and again, last one for the year, we're going to come back because, okay, tomorrow is December 19th when this is actually out. So the 26th is the last Friday. So we're going to be back probably January 2nd, 3rd.
Yep.
Is there anything you want to tell people at the
No,
end of
I
the
hope
year?
I hope everybody has a wonderful holidays. We've had a great year, and we appreciate all of your viewership and help and comments and questions. And we've enjoyed it. We've enjoyed this year, and we are looking forward to a phenomenal 2026.
You said it all. I love it. Thank you so much, Brad. It's so good to have you. And for anyone listening, send us your questions, send us your thoughts. We love to hear them. And we hope you have a wonderful, wonderful rest of your holiday season. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough. You are enough. And your birthright in this lifetime is to be expansive.